Hey there, Tanya Taylor of Grow Your Wealth TV, and today I'm going to be sharing with you the 5 mistakes that new investors make. Now, if you're new to my channel, please like, subscribe, and share. And to get new content, please hit the bell. So I'm going to dive right in. The first mistake that new investors make is not understanding the investment. So it could be that they don't understand the business model of the company, or they just don't understand the company itself. And one of the principles that Warren Buffett talks about is consistency. And he talks about if you don't understand a company, that you should not buy it. That kind of goes without saying, but a lot of times people may get some stock tips and they will go ahead and buy the stocks, and then they incur large losses. So what I would say or offer is that you get educated, you do your research before you purchase any stocks, because if you don't understand the investment, then you may end up getting a lot of loss. I know during the tech cycle, when all the technology companies were coming in the early 2000s, like I purchased so many tech stocks, and it was like all on stock tips. And part of the reason was because the stock prices kept going up and I wanted to make a lot of money in the market. So of course, what goes up without any proper fundamental always come down. So then the bubble happened, and a lot of the tech stocks of course went to zero because the companies went away, and so I lost a lot of money. So of course I learned from that. I have to say also that I did have a model in place. I just wasn't using it because I wanted to make the quick money, and I realized that you just don't make the quick money. It's too risky, and it's not really something that you want to do. So now I never ever invest unless I have done research on the company, and I mean like really good research. And if there is an industry that I don't fully understand, or a company that seems very complex, I will not invest in that company, because I know that there is a chance that if something happened with the company, I'm going to lose my money, and I don't really want to lose my money. Okay. The second step is falling in love with a company. How many people do that? I would love to hear from you. Have you done that? So no one really cares how much you pay for a stock at the end of the day. The company who sold you the stock doesn't care. Wall Street doesn't care. Dow Jones doesn't care. Like, nobody cares. But we get so emotionally attached to a company. And if the company price goes down, we don't want to sell the stock. So there are two things that could happen if you bought a company and the price goes below the cost, right? It could be that there's volatility in the market and the price is just reacting to the volatility, or something is going on to the industry at this point in time that's affecting the stock, and so the stock price went down. But because it's a strong company, because you've done your research and you really believe that it's going to weather the storm, so you just say, okay, you know what, I'm going to hold on to this stock because there's nothing that shows me that I need to get rid of the stock. And there's the other piece where there is a legitimate reason why the stock is going down and the value is never coming back. An example of that for me was when I held Blockbuster, and then of course the industry started to change. Blockbuster didn't innovate fast enough. And what was happening is that the stock was losing value by a lot. So the cost of my stock versus what the price was pretty low, but I knew that it was changing, and I knew that I should have sold, but I was so emotional about it. I just didn't want to lose the money. So I kept holding on to it with the hope that it was going to go back up. Well, guess what? It didn't go back up. And so I lost all my money. I'm sure that I'm not the only one that has happened to. And if you're watching this and this has happened to you, please share and let me know what you learned from that. Okay, number 3 is lack of patience. So this is where, again, if we have a plan in place that will help us in terms of lack of patience, if you know that a company is pretty solid, but the price isn't going up as fast as you would have liked it to, then it's okay to hold on to the stock if you've had your time horizon and nothing is happening. However, there are times where people will say, oh my gosh, I bought this stock, I expected it to go up, and it's not going up, so I'm going to sell it. And they sell at the wrong time. So you always want to be realistic about your expected return. An example that I think is like a really good example is Chipotle. So Chipotle has always been a pretty solid company. The stock has done well. And a couple of years ago, there was something that happened and a couple of people got sick. But fundamentally, when you look at the company, nothing had really changed. Investors just needed to kind of weather that storm and sort of stick with Chipotle until they got through that period. but a lot of people sell, and so the stock price dropped by a lot. And there were a lot of people that were happy for that, so they went in and they purchased the stock. But then the stock was there, and the stock price didn't move much for a couple of years. And I'm sure some of the people who bought it also sold it because they were just kind of sitting there and it wasn't moving. Well, now Chipotle is over $1,000. So having that strategy and kind of sticking with that strategy, knowing that nothing fundamentally has changed with the company, will keep you in a position where you will benefit from the gains in the company as opposed to selling too fast. So you just got to be patient and weather the storm. Okay. Number 4 is trying to time the market. And actually, market timing is perfectly legal, and it's an investing strategy where investors attempt to identify times when they get in and out of the market, and they're using things like forecasts and analysis to do that. So you find that many brokers, financial analysts, as well as mutual fund portfolio managers try to use this strategy because they're trying to give their client the highest return, but it does not really work. And so the Center for Research, Retirement Research Study actually did a study just to look at fund managers, mutual fund managers who sold based on market timing versus their peers who did not sell. And what they found was that the one who sold based on market timing actually underperformed. Now, the amount that they underperformed by was not significant, but it just goes to show you though that it was still underperformance. And it just goes to show you, like, these are people who are supposed to be experts in their field, who are supposed to know a lot more than we do, and still they weren't able to time the market. So having, again, I cannot say enough, like having the strategy of just holding on, buying quality company and watching it over time is a much more prudent decision than trying to time the market and losing your money, because a lot of people, when they try to time the market, they end up buying at the wrong time and selling at the wrong time. So they end up buying high and selling low, and so they end up with losses. So hopefully you guys are finding this useful. If you do, please like and share and subscribe as well. Now, I'm going to now talk about the last one, which is number 5, not diversifying your portfolio. It's very, very critical that an investor diversify their portfolio to minimize the amount of risk that they're going to be taking on across different industry. So you want to think about your portfolio on almost like a mini mutual fund, but without the P's. So you might have some investment in tech, and you might have some in bank and consumer product, in energy, however you want to sort of diversify. But some of the things that you want to think about as you're thinking about diversifying your portfolio is, what is your investment goals and your investment strategies? Because if you're investing short term, you might want to invest in value companies or dividend companies, as opposed to someone who might say, you know what, I'm investing for the longer term, so I'm willing to take on more risk because I'm investing for like 5-10 years and beyond, and so I'm going to invest in the growth companies because I think the returns are going to be higher. And that's how you want to think about it as you think about diversification. Okay, so my question for you is, do you have a diversified portfolio? And I also really want to hear from you whether or not you have made investing mistakes, and what are some of the mistakes that you'd make. So please, in the comment box below, share that information, because many people rely on this kind of information so that they don't make the kind of mistake as well. And again, if you like this content, please share it. Also, I have a free gift below. If you click on the link, you will get access to 5 steps to investing in the stock market.